And I'm talking about what happened at Silicon Valley Bank. Because yesterday, they dropped the first bombshell on the market by announcing that they were going to have to raise, I don't know, a couple billion, I forget the amount, in new equity. They were going to sell stock because they had lost a bunch of money on their loan portfolios, and so they needed to sell stock. And the shares were down about 60%. They dropped from like $300 a share to about $200. And these aren't the exact prices. I'm just, approximating. Now, the 52-week high was around $600. So the stock has gone way down on that news. And also, by the way, yesterday, Silvergate Bank, I think it was just after there was a dead cat bounce in the stock, and I pointed out that was your last chance to get out, and now the dead cat has stopped bouncing. It's, dead. It was down big again today, down to about $2. That's down from, I don't know, it was 600s, whatever it was. Oh no, actually not quite that high, 100 and something on that one. But it's going to zero. There was some Hail Mary. They were going to try to save the bank. Well, that fell incomplete. In fact, it was probably intercepted and run for 6 points the other way. That's how miserable this Hail Mary was. But that's it. It's gone. The premier crypto bank is history. And for all the people who think that crypto is the future, why is the biggest crypto bank now history? This is big problems for crypto. By the way, Bitcoin back below 20,000. As I am speaking right now and doing this podcast, it's at 19,950, so close. But remember, Bitcoin had bounced all the way up to 25,500. It's now down 20% from that peak, so that's bear market territory. Of course, we've been in a bear market the whole time. That was just another dead cat bounce, although I guess the Bitcoin dead cat is going to take longer to stop bouncing. But believe me, it's dead. The people that own it just don't recognize that yet. The impending financial crisis that I have been warning would happen for years for the precise reasons that it is now taking place. So I'm going to talk about some stuff today, but I've talked about it all before. Years ago, I warned that exactly what is happening right now would happen, and for the precise reasons that it's now happening. Now, I don't know anyone else that talked about it, right? So the mainstream media looks at this as like, oh, well, nobody could have predicted this. Yes, people did predict it. I know I was one of them. But it's going to get a lot worse from here. That's what the mainstream still doesn't understand. And so what happened today with Silicon Valley Bank is they announced that, or I don't know if they announced it or the government announced it, the FDIC, but they couldn't find any takers for that stock. I wonder why, right? Nobody wanted to step up and catch that falling knife. So the bank couldn't raise the capital that it needed. And so it's been put into receivership by the FDIC. So the bank is shut. The stock never opened for trading today. It's probably worth nothing. So you had a bank go from 300 to zero in basically one trading day. Totally out of left field. In fact, last month, Forbes magazine came out with its best banks in the United States. It made a list of best banks, and Silicon Valley Bank was number one. It topped the list, and in 1 month, it's bankrupt. Now, the bank had something like $175 billion worth of deposits, $150 billion of which are not insured. The FDIC insures $250,000 of deposits. If your account is worth more than that, it's not insured. I mean, you're protected up to the 250, but beyond that, you're on your own. And this is a big deal. So first, let me get into what happened to this bank and why. And this is just one domino. A whole bunch of them are going to fail. I think the plunge protection team is going to be working nonstop over the weekend to try to figure out a rescue plan before the market opens for business on Monday morning, because who knows how many shoes might drop over the weekend. The market should have been down a lot more than they were. In fact, the Dow Jones, I don't even think it was down 400 points today, or just under 400 points, 345. That's not that big a drop. In fact, on the week, the Dow and the S&P are only down about 4%, or Dow NASDAQ. Gold stocks were down 5 to 6% on the week. Even though gold rose, it was up $35 an ounce today. it was up about 12 bucks on the week, but gold stocks hadn't recovered from their 30-day drop. Gold dropped $30 rather on Tuesday in response to Powell's so-called hawkish testimony about the super strong U.S. economy. And so gold stocks got clobbered and they never got back off the mat. Even though they were up about 2% today, they couldn't recover the losses from earlier in the week, even though gold itself was very strong at the week. In fact, not only did it hold nicely that 1800 support that I mentioned I thought was support, it closed at almost $18.70 an ounce, so $70 above that support, which it just touched. So gold bid, and it's being bid for the same reason that bonds were way up today, the dollar was down today. Investors are anticipating some type of Fed pivot, where just a few days ago they thought, no, that's not going to happen. But the events from today with Silicon Valley Bank has now got people thinking that the Fed is going to have to do something. And they are going to have to do something, except it ain't going to work. That is the problem. That's what nobody understands. So getting back to what happened with this bank, and this again is something that I was warning about years ago. One of the downsides of low interest rates, and I've been warning about this, and that's why we don't own financials in our brokerage account. I mean, we stayed away from the financials for this reason, because lots of people were saying higher interest rates are going to be good for financials because they could earn more money. I was one of the few people out there that said, no, higher interest rates are going to destroy financials, because most people in the investment banking business don't even understand their own industry. Why do you think so few people knew that the 2008 financial crisis was coming? I understood the weak position that the banks were in during the housing bubble, and I understood how weak their position was now going into this coming financial crisis. Everybody else, oh, the banking system is sound, it's sound. It is completely unsound. Here is the flip side of low interest rates. While interest rates were really low, all of these banks, in order to earn income, had to take their deposits and invest them in low-yielding paper. They bought a lot of government bonds, treasury bonds. That's what they had to have. That was considered excellent collateral, right? Full faith and credit of the U.S. government, except they didn't buy short-term because there was no yield there. The yield was at zero. So what did they do? They bought 10-year treasuries, 30-year treasuries at maybe 1.5%, 2%, not a lot of yield, but better than nothing. So they bought all these bonds. They also loaded up on mortgages, either the ones that they originated or they bought them in the secondary market, mortgage-backed securities. Personally, I've got a mortgage on my Connecticut house. I got a 30-year fixed. Maybe there's 25 years left on it, 26. I'm not sure exactly. But I'm at 3 3/8. The current mortgage rate is 7%. What do you think that mortgage is worth? If Bank of America, which owns my mortgage, if they wanted to sell that, they're not going to get anywhere near what it's worth, anywhere near what they've marked it on their books, because they're not marking that loan to market. No, they're pretending it's still worth what I owe them, but it's not worth that. I mean, yes, it's worth that if they hold that mortgage for the next 26 years, but what if they need to sell it? What are they going to get? What can you get for a mortgage at 3 3/8 when the current market is at 7? That's the position that Silicon Valley Bank was in, because a lot of their depositors wanted their money back. Now, one reason is they bank a lot of tech companies, and these tech companies are in a lot of trouble. They're losing a lot of money, so they're tapping into their bank deposits. Maybe they deposited some of the money that they got from selling stock to a bunch of suckers, but now they need that money to cover their losses, so they go to their bank and they ask for the money. Now, the bank doesn't just sit on the cash. In order to get the money, they got to sell their mortgage-backed securities. They got to sell their U.S. treasuries. Well, what are they worth? A lot less than they have them on their books. That's why they lost a lot of money, and now they need help. But there's also something else that's going on. And this is another thing that I predicted. The interest rates are going up. You can get almost 5% now on a treasury bill. Money market yields have moved up a lot. But if you've noticed, if you have a bank account, your bank is barely paying you any interest. Maybe you're getting 25 basis points, 50 basis points. You're not getting anywhere near what is currently being offered by the U.S. government on treasuries, on bills. Why is that? Because the banks can't pay, because they've already loaned out all the money and they're locked in at these low rates. So they can't pay their depositors enough interest to compete with the U.S. government. So what is that going to do? That's going to create a run on the banks, not just on Silicon Valley Bank, but all these small banks, these regional banks. People are going to start pulling out their money.